When the stock market reaches its peak, it often takes years of gradual growth and careful management. You might have a great track record, making you feel confident as the market climbs higher and higher. Investors tend to feel euphoric as they watch their portfolios grow, believing that the good times will continue indefinitely. However, it's precisely at these market peaks when things start to shift. While the market is still high, the sentiment begins to change subtly. You still feel good about your investments, just not as great as you did the day before. This gradual change in sentiment is what makes identifying market peaks and subsequent declines so challenging. Imagine driving through a dark tunnel, searching for the light at the end. Often, there is no clear light signaling the end of the tunnel. The market tends to turn when things are at their darkest, yet just slightly less dark than before. By the time most investors realize the market has turned, they've already missed the first significant drop. Jeremy Grantham, a highly respected voice in finance, is renowned for his ability to spot bubbles before they burst, and for his warnings about potential financial dangers. Today, we're delving into Grantham's stark warning about a looming financial bubble and exploring how you can prepare for it. Jeremy Grantham has spent years studying financial bubbles across various asset classes, including commodities, currencies, and stocks. His research indicates that bubbles often follow a pattern of rapid price increases, followed by a sharp crash, where prices revert to their pre-bubble levels. But what differentiates a bubble from a simple market correction? Grantham's recent analysis highlights key indicators that suggest we might be in a bubble today. Let's break down his findings. Grantham uses a statistical measure called 2 sigma to identify outliers in financial data, defining a bubble as a situation where prices move 2 standard deviations away from the mean. In a random world, this occurrence should happen approximately every 44 years. However, in reality, it has been observed roughly every 35 years, which is remarkably close. In developed stock markets, every identified bubble has historically returned to the pre-existing trend line before the bubble formed. However, in developing markets experiencing significant economic shifts, such as transitioning from an agrarian to a manufacturing economy, prices can remain elevated for longer periods, reflecting a paradigm shift. For instance, oil prices stayed relatively flat until the formation of OPEC in the early 1970s, which led to a significant and sustained increase in prices. So, where do we stand today? According to Grantham, the U.S. market has surpassed the 2 sigma threshold, technically qualifying it as a bubble. However, what he terms super bubbles possess additional characteristics. One hallmark of these super bubbles is the divergence between speculative leaders and blue-chip stocks. In such scenarios, speculative stocks, which typically have a higher beta than the broader market, begin to decline significantly, while blue-chip stocks continue to rise. Grantham draws a parallel to the events leading up to the 1929 crash, where low-priced speculative stocks surged by 80% in 1928 before sharply declining throughout 1929. This divergence signaled underlying market distress. By the time the broader market crashed, these speculative stocks had already been falling, indicating underlying instability. A similar pattern emerged in 1972, when the S&P 500 rose by 177%, while the average big board stock fell by the same percentage, a striking divergence. This pattern re-emerged in 2000 during the tech bubble. Many speculative growth companies, including numerous dot-coms, imploded in early 2000. By mid-2000, many small speculative stocks were down 70–80%, while the larger ones fell 30–50%. Despite this, the S&P 500 continued to climb, reaching a peak in September. This meant that non-growth stocks had risen by about 15–16%, balancing the declines in growth stocks and keeping the S&P flat. Grantham notes that a similar pattern appeared in 2021. The speculative leaders, including meme stocks like AMC and innovative companies in Cathie Wood's ARK portfolio, began to nosedive. Grantham had a personal stake in this bubble through his investment in QuantumScape, a company he had invested in 7 years earlier. By December 2020, QuantumScape's stock had skyrocketed from $10 to $131, a 50-fold increase. This massive gain made it his largest position, although he couldn't sell or hedge it for 6 months. The peak of QuantumScape's stock in December 2020 was followed by a broader decline in new issues and aggressive growth stocks by January and February 2021. By the end of 2021, aggressive growth stocks had been hammered, yet the S&P 500 was up over 20%. This remarkable fourth instance of speculative divergence signaled impending market trouble. Grantham had been warning of this in his writings, initially under the title Waiting for the Last Dance, and later, as the bubble progressed, Let the Wild Rumpus Begin. By the first half of 2022, the market experienced the largest first-half decline since 1939, with every asset class, including bonds, plummeting. This period was marked by significant market distress. But then, a new twist emerged with the advent of ChatGPT, an AI technology that Grantham describes as a snake in the garden party. Its introduction in late 2022 changed everything. Grantham, like many others, was quickly impressed with ChatGPT's potential. Despite only a few companies being heavily involved in AI, their impact dragged the entire market up for 10 months, even as the broader market drifted down to flat. This phenomenon was driven by the hype around AI, with companies positioning themselves as heavily invested in AI development, similar to selling shovels during a gold rush. This AI-driven market action disrupted what had been a relatively well-behaved bubble. Grantham had expected the market to continue its decline, but the excitement around AI stocks caused a renewed market rally. By November 2022, this had led to broad market participation, with significant gains driven by AI stocks. However, Grantham remains cautious, noting that this rally is happening at a time of full employment, high profit margins, and other conditions typically unfavorable for starting a bull market. Instead, these conditions are usually where bear markets begin. Great bull markets, Grantham explains, begin under the opposite circumstances. The ascent to market peaks feels wonderful because it's accompanied by peak profit margins and a great track record. Investors feel increasingly confident as the stock market climbs, creating a sense of euphoria. However, this is precisely when the market is most vulnerable. The decline starts subtly, with investors feeling just slightly less optimistic than the day before. This gradual shift in sentiment makes it incredibly difficult to time the market accurately. Grantham points out that by the time investors see the light at the end of the tunnel, they've often missed the initial significant declines. Grantham also addresses the bullish argument that this time is different. Bulls often claim that new technological advancements or unique economic conditions justify higher market valuations, implying that historical metrics are no longer relevant. Historically, this has been a dangerous assumption. John Templeton famously called it the most dangerous phrase in investing. Grantham recounts a debate with Jim Grant on this topic, arguing that while this time is different has been perilous for 100 years, the assumption that this time is never different can also be dangerous. Occasionally, significant shifts do occur, fundamentally altering market dynamics. For example, Japan's stock market reaching 65 times earnings in the late 1980s and the oil price surge following the formation of OPEC in the early 1970s were unprecedented events. These events changed the world in lasting ways, demonstrating that sometimes the game genuinely does change. Grantham notes that while history shows that profound changes are rare, they're not impossible. Investors must remain vigilant for these rare moments when the market does truly shift. The reason significant changes are rare is that market dynamics are largely driven by human nature, which is inflexible over time. Grantham emphasizes that human behavior has remained consistent throughout history, whether during the South Sea Bubble in 1721 or the speculative bubbles of the present day. Humans are capable of both irrational exuberance and cautious pessimism. This consistency in human behavior means that while markets can exhibit irrational trends, they also tend to revert to historical norms. So, what should investors take away from Grantham's analysis? Jeremy Grantham's advice on investing reveals a deep skepticism about both traditional and emerging financial assets. His analysis emphasizes caution and critical thinking for investors. Grantham urges investors not to mistake past performance for future guarantees. Although U.S. stocks have excelled historically, it doesn't mean they'll continue to do so indefinitely. Grantham warns that high returns and market dominance might not persist, especially with larger companies whose power can distort traditional capitalist mechanisms like mean reversion. He points to the relative stagnation in markets outside the U.S. as a warning sign that investors must recognize. His key message is to avoid complacency and constantly assess risks and opportunities. One of his central tenets is the idea of an extreme margin of safety, particularly for younger investors. Grantham suggests investing in areas with significant potential while remaining cautious of overvalued sectors. He encourages a focus on sustainable investments, such as green venture capital, despite their high risk. Grantham's approach also includes adapting strategies to current market conditions, which means a higher cash allocation now due to perceived overvaluation. He promotes a flexible, thoughtful approach to investing that accounts for the constant change and evolving dynamics of the market. By integrating these principles, investors can navigate financial uncertainty with greater resilience and foresight. If you found this breakdown helpful and want more insights like these, make sure to subscribe to Economic Hero and hit the like button. Your support helps us continue bringing you valuable financial content. Stay informed and stay ahead of the market.